Market analysis is an important first step in making any investment decisions. A perfect example of the importance of market analysis is the real estate market. Identical houses should in theory have identical values, but in reality a house in an upscale or high demand neighborhood is going to be worth a lot more than an identical house in a rough or low demand neighborhood. Well, just like the real estate market or neighborhood has a huge impact on the value of a house, the overall stock market has a tremendous amount of influence on how much an individual stock is worth. Well, there are many things that can impact the overall market, and some of them are more important than others. An efficient market is like a well-oiled machine, like a car that's running properly. There are a lot of parts that go into making a car run well. Some of them are more important than others. A car could probably function fine without a carpet, stereo, mirrors, or climate control. Take the powertrain away though, and you've got a major problem. The powertrains that run the stock market are corporate profitability and interest rates. Anticipated corporate profitability along with interest rates are thought to matter more than anything else to the stock market. Everything else is secondary to that. Political concerns, humanitarian causes, and cultural issues won't impact the market except as they impact corporate profitability and interest rates. Now, this makes sense if you think about what stock actually is. When you own a stock, you literally own a piece of a business. If that company is likely to be less profitable in the future than it is now, the value of that company is likely to go down. On the other hand, if a company is likely to be more profitable in the future than it is now, the value of that company will go up. Once you can make this connection, analyzing the market can be a lot simpler than if you don't have this perspective. Well, there are three basic steps involved in daily market analysis. The first step is to look at major index values. Looking at a combination of indexes such as the S&P 500, the NASDAQ, and the Russell 2000, that'll give you a good idea of what the market as a whole is doing. Looking at a historical chart can really help put those numbers into perspective. Are the indexes moving together? Are there any signs of divergence? We'd suggest viewing at least a 6-month historical time frame to make sure that you have a good picture of the overall trend of the market. Well, the second step is to pay attention to the news. There are all kinds of difficulties that come with trying to analyze the news. Biased reporting, a 24-hour news cycle, and seemingly endless hyperbole can sometimes lead to confusion and frustration. But worst of all, by the time you've correctly interpreted the news, you're probably too late to do anything about it. So, how do we use the news? Why pay attention anyway? Well, mostly we just pay attention. We need to know what the market is paying attention to in order to be prepared to react to any new developments. For example, if we know that there's a major trade dispute that could have an impact on corporate profitability, we should be prepared for any new developments in that dispute. If we know that the market is concerned about inflation, we should be aware of upcoming events that might have anything to do with inflation. As far as being able to tell if a news story is important or not, let me suggest 2 simple questions you can ask yourself. First, does the news story have anything to do with corporate profitability, or will it impact corporate profits in any way? To simplify the question, you could pick a couple of major international companies like McDonald's or Microsoft. Ask if the story is going to impact how much money those companies make. If so, then it's probably an important news story. If not, you can probably move on. The second question is it biased? Well, there will always be a natural inclination to follow our own biases. For example, it's proven that Democrats take a dimmer view of the economic outlook in the United States when a Republican is elected president. Republicans take a dimmer view of the economic outlook in the United States when a Democrat is elected president. A savvy investor will be aware that they have personal biases and will work to overcome them. If you can't acknowledge your bias, you're most likely blind to it, and this could lead you to suffer from something known as confirmation bias. A confirmation is a trap that's easy to fall into and a potentially deadly one for your portfolio. Make sure that if you feel yourself constantly drawn to the same type of articles, like maybe you're always reading doom and gloom articles, balance them out with more positive news articles and vice versa. This can help give you a balanced view of what the market is paying attention to at any moment. The next and third step in analyzing the market is paying attention to upcoming economic events. Find a good economic calendar and just be aware of any major events that might be coming up. If you're serious about actively investing, you'll take the time to analyze the stock market every day. In the modern world, there's no real excuse for not being able to monitor the overall market along with your positions on a daily basis. With modern technology, you can do this using your cell phone while you're on a break at work or while you're waiting in line somewhere. A simple review of the market can be done in just a few minutes. If you're struggling to do this, find a way to make the time somehow. It can help make your investing easier and take a lot of the mystery out of your portfolio.